Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, as always, Mr. Neil Gibb, and today I want to talk to you about the sunken cost fallacy. And the reason I want to talk about the sunken cost fallacy is because I feel like I'm in a real privileged position to speak to the amount of investors that I speak to on a daily basis. And like attracts like, right? So because I'm a property investor, because I'm in business, I love speaking to other people to find out what they're doing, and more importantly, why they are doing it. Because the why can determine if you get the outcome or not. If your why is strong enough, the how or what is easy once you know why you want it. And I did a post on social media last week, and it was a picture of me stood on the mountains in Papua New Guinea with my hands in the air, and this mountaintop had broke through the clouds, just fully picturesque. And at that time, 10 years ago, I thought I was really killing it in life. I was earning some good money. I was working in countries that people would love to go to and get paid to be there. But on the flip side of that, what I realised one day is when my wife was driving me to the airport, she started crying. And she started crying because I was going back to work for 3 or 4 weeks, sometimes 8 weeks on some of the swings that I did. And although I was earning good money and I thought I was the provider, what I realised is that time is more important than money. And that was my why I wanted to change my circumstance. And real estate was one of the things we were always interested in. And that is why we started to invest, so that we could, didn't realise we were going to replace our income at the time, but at least set up a secondary income stream so that I didn't have to do fly in, fly out. Maybe I just worked in the CBD for 40 hours a week. But that reason, that moment right there is why we're here right now. And this is why I like to speak to a lot of other people to find out why they are doing what they are doing. And you might be thinking, what's this got to do with the sunken cost fallacy? Well, the sunken cost fallacy occurs when individuals continue a venture or project due to the significant resources that they have already invested, rather than evaluating the venture's future potential or the future potential of the time and energy and money that they are putting into that project. And again, I get to speak to a lot of property investors, and I speak to first-time property investors, and I think the biggest portfolio I've seen personally is 45 properties. So I get to see lots of different things. I get to hear lots of different whys. I get to see lots of different ways that people have done things, and I get to see if I can add value to their journey with HMO or NDIS properties. But what I also see is people tend to get stuck at a certain point in their journey, and sometimes that's because they've either invested in the wrong properties, they have structured themselves in the incorrect way, or they have bought the right property, but it's just not giving them the returns that they need. And I want to give you an example of somebody who will obviously remain nameless. But I just want you to remember, as I'm telling you this story, that real estate is a vehicle to help you serve a purpose, to help you fill your why. Whether you want more time, whether you want more freedom, whether you want to tell your friends that you're financially free, whether you just want to build a massive portfolio to fill your ego. I don't really care. It's your journey. Everybody's journey is unique to them. But remember, you don't need to hold these properties forever. And this story that I'm about to tell you now is a classic example of somebody that is well and truly stuck in the sunken cost fallacy, because their portfolio was worth $7 million. Now, as you listen to this, who would like a portfolio that's worth $7 million? I know I would, if it was done correctly. They also had $3 million of equity So that means that they could sell down that portfolio and have $3 million left over. Now, there's obviously tax implications and stuff like that to consider. But having $3 million of equity, it's a pretty good position to be in, right? However, this $7 million portfolio was negative cash flow. It was affecting their lifestyle because every single month they had to tip money into that portfolio from the money that they were earning from their job to keep the portfolio alive. And going back to that, when they first sat down with me, I said, "What? How big's your portfolio?" They told me, "Do you know exactly what it's worth?" And they said 7 million. I said, "Impressive, very well done." But I could see on the face that there was something not quite right there. They didn't light up, and I congratulated them on having a portfolio worth $7 million. When we dug deeper, it turned out that they were paying $35,000 a year to keep this portfolio alive. And this is when I go back to the why. So why did you get into investing in property? For freedom, to build wealth. Awesome. How's that going for you? Well, we're building wealth, according to them. But it's affecting our lifestyle. And my feedback to them was, look, if I was in your position right now, I would sit down with a financer, someone that's got the ability to look at your portfolio and strategize with you on what you should let go of, because some of them properties may have already served their purpose. Some of them may have seen huge capital growth, but that yield might not have kept up with that capital growth, or you could have leveraged from that capital growth into another deal, which is now seriously affecting the yield on that first property. And sometimes we can leverage 2 or 3 times from the same property, depending how well it performs. But each time that increases the holding cost on that, which reduces your returns. And this is why we always focus on cash flow here, because the higher your cash flow, remember we did a podcast a few weeks ago on serviceability and borrowing capacity and getting yourself market ready. When you're $35,000 a year negative cash flow, that's $35,000 off your income that the bank will remove from your income and then calculate your serviceability and borrowing capacity based on that new figure. So again, you don't need to hold these properties forever. However, if you've got a golden goose, which is laying golden eggs, then you could potentially hold it forever. But if it's not laying golden eggs, then you've just got a goose, right? You've got a $7 million goose right there that's not laying any eggs. So what do you do in that circumstance? Considering the sunk cost fallacy is when individuals continue a venture or project due to the significant resources that they have already invested, rather than evaluating the venture's future potential. Now, if this was me and I was stuck and I couldn't move forward because I had no borrowing capacity and I was negative cash flow, I would be quite easily slaying some of these gooses to see if there was any golden eggs that I could recover. However, there's the emotional investment trap. And this comes down to the more time and money that someone invests in something, the harder it is to abandon it, even if it is no longer beneficial. Even if it is no longer beneficial. And going back to real estate as a vehicle to serve a purpose, a lot of people don't want to sell properties because they're scared of paying tax. There's this thing in Australia where everybody wants to save tax. Paying tax is a good thing. It means you're making money. My accountant, Nitin Vashisht, and I realised that he got this from somebody else, but somebody else said it years ago as well, that there's 2 things in life that are certain: death and taxes. You will pay taxes, and it's a good thing because it means you're making money. Now, there's ways you can reduce your taxes, but let's not try to just avoid them altogether, because that means you're making no money. You've got to have an income that's taxable so that when the bank looks at you, they go, "Oh, you earned $200,000 last year and you paid X amount of tax. Well done." But if you paid no tax, it means you're fucking earning no money. So let's just get over the fact that sometimes you need to sell these properties and pay capital gain tax on these properties, right? Now, there's a thing called the 50% capital gains tax discount, which means that you only pay tax on only half of the net capital gain of the asset. So, for example, you buy a property for $500,000. That property rises in value to $1 million, and you sell that property. Simple maths, you've made $500,000 of capital gains tax. We won't factor in all the other costs associated. I want to keep the numbers really simple for this example. The 50% CGT discount means that you only pay tax on $250,000, and $250,000 is tax-free. Now, I don't know about you, but if you've just invested in a property and it's naturally grown in the market, to pull 250 grand out of there tax-free, and then whatever's left from your tax, the other 250 grand will be allocated to your taxable income. Depending on how much you and your partner have earned, you might pay another 32, 35, 40% tax on that. Big wow. You've got your money out of the deal. You can then put that into an asset which produces income. Remember, income is the outcome that we want when we invest in property. Capital growth is the tool that gets us to a point where we can invest in more assets. Now, we also deal with lots of business owners, and as myself as a business owner, a lot of the business owners that I speak to are doing something similar to me, where we're not leveraging our portfolio currently. We are using profits from the business to expand our portfolio, and we're in debt reduction mode. Depending on who you are, what your journey is, what your goal is, how fast you want to get there, etc., etc., etc. Nobody's journey is exactly the same. Your journey is unique to you, and how you do it is entirely up to you. I can only lead the horse to water, cannot make you drink it. So going back to the emotional investment trap, there's also something called the ignoring opportunity cost, or the undervaluing of alternative uses of resources. And this is focusing on sunk costs can lead to ignoring potential gains from other investment or opportunities. Now, again, you could be getting held back from borrowing more money because you're being tapped out, borrowing capacity wise. The only way to do that is to increase your income. And if you sell a property and the 50% capital gains CGT discount, easy for me to say, the 50% that you are getting taxed on gets added to your taxable income, which increases what you earn for the year, which means you can potentially earn more money. I'm not a broker. I don't claim to be an expert in this space. I have an expert team around me, and I've done enough deals to understand where this and how this works. So the ignoring opportunity cost, or the underlying alternative use of resources, means that sometimes you need to slay your goose. Check if there's any golden eggs in there. If there is, go back out, get a goose that's laying eggs, and then live off the eggs. Live off the eggs, guys. That's the key. Income is the outcome. Capital growth is vanity. Cash flow is sanity. You can't eat capital growth. You can leverage it all day long, but it doesn't pay the bills unless you slay the goose. And you need a goose that lays eggs so that you can continue to pay these reoccurring bills: mortgage payments, gas, water, electric, school fees, holidays, cars. I've got no problem with people having these things in their lives. I think it's great to enjoy the success and the fruits of your labour, but don't work harder to get these things. Make your money work harder for you so that your money is working hard to give you these things in life, and you're actually doing less, not more. This is the key, guys. This is the key. By the way, I went to see Steve McKnight last night. He was over in Perth, did a little presentation on the market in general, and then he did a little bit of a presentation on his fund that he's done, and the new fund that he's setting up to buy commercial property in Australia. I've got a lot of time and respect for Steve. I'm actually trying to get him on a podcast. We're going backwards and forwards at the minute in times and dates. However, when I bumped into quite a few people last night who recognised me because of the content that we're putting out there. And I want to say thank you to everybody that stopped me and said hello and said that they enjoyed listening to the podcast. Really appreciate it. It got a little bit embarrassing because I had a few people that were like, "Oh my God, I listened to your podcast." And I was like, shit, you don't realise the reach that you can get on these things until people actually stop you. So I appreciate the kind words, everybody. To help us get more traction, I would really appreciate it if you could share or like the episode, whether you're listening on YouTube, whether you're listening on Apple Podcasts, Spotify. Leave us a review, give us some stars. Be honest, guys, I love the feedback. I'm aware that I cannot please everybody, but I will try and please as many people as I possibly can. So back to the sunk cost fallacy. Breaking free from the fallacy, right, is recognizing the sunk cost fallacy and making objective decisions based on future potential. Now, I hope that the things that I've mentioned today in this podcast, if you're in a position where you've got a portfolio that's not giving you the outcome that you want, and look, the market has seen a lot of growth. Perth, Adelaide, Brisbane, Sydney are all in upward trends right now. Melbourne's on a bit of a downward trend. But if you've got equity in your portfolio and it's not doing what you're doing, it's not giving you the outcome that you desire, you could be closer to hitting your goals than you think. However, you need to be aware of the sunken cost fallacy. You need to be aware of the emotional investment trap. And you need to be aware of ignoring opportunity cost, because you could be in a position right now that could drastically change your life with a few small changes. So I hope that helps, guys. It's just a quick, short little podcast for me today. I really wanted to share this with people because I speak to a lot of people that are scared to sell because they're scared to pay tax. But paying tax is a good thing. And if you pay a little bit of tax and it gets you into a property that can transform your life, then that's a good space to be in. I'll just give you an example back on that client's portfolio. $7 million portfolio, $3 million in equity. They could sell that down. Let's say they're left with, let's say they pay $1 million in tax. There you go. Not that they would, but let's say that they do. They're left with $2 million. You could buy 2 HMOs, unencumbered, no debt, and them HMOs could be delivering you $150,000 to $180,000 a year of cash flow. Now, that small change of having negative cash flow to $150,000 to $180,000 cash flow and no debt, you don't have to worry about interest rates anymore. Who cares what the Royal Bank of Australia is doing to interest rate rises and the cash rate, etc., and stuff like that? Because you've got 2 properties that are unencumbered and they're churning out $150,000 to $180,000 a year after all expenses, cash in their pocket. Now, the person that I'm talking to did not take that feedback. From what I understand, they've still got this portfolio because it sounds fantastic. I've got a $7 million portfolio. I would rather have a $2 million portfolio and $150,000 a year cash flow and time to then do the things in life that I really want to do. So here's what you can do. If you have a portfolio and you don't feel like it's performing for you right now, reach out to me and I can connect you with a strategist that can go through your portfolio for you. Now, there will be a cost for this, and it's going to be between $1,000 and $1,500 per session. It's going to be one session and they're going to break down everything that you've got. I'm not going to make any money from this. I'll connect you direct with that person and you can deal with them personally. But they're going to break down your portfolio, tell you what's holding you back, and then it's up to you whether you take action. And it's up to you whether you remove yourself and start to understand the sunken cost fallacy. Because a few small tweaks could make all the difference in your journey as a property investor. So I hope that helps, guys. If you've got any questions, as always, reach out to me. Again, I would really appreciate it. If you're enjoying the podcast, hit share, hit follow, give me some stars on Spotify. I really appreciate it. It helps the podcast get more reach. It helps us help more people. And that means we can continue to deliver quality content for you guys, the listeners. And remember, every master was once a disaster and every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.